Hello, this is your Interactive Accountant's News Brief. Federal tax changes were supposed to simplify life for business owners. Instead, they are creating a growing divide at the state level, and that gap is becoming a real financial risk heading into 2025 and 2026. States across the country are making independent decisions about whether to follow federal tax law or to go their own way. The result is higher compliance costs, unexpected state tax bills, and new planning challenges for businesses of all sizes. As federal rules governing bonus depreciation, research and development costs under Section 174, and business interest deductions continue to evolve, states are increasingly choosing whether to conform or decouple. Some states automatically adopt federal tax changes through rolling conformity. Others lock in the tax code as of a specific date. Many selectively reject certain federal provisions altogether. According to recent SALT analysis from Grant Thornton, this patchwork approach is accelerating, driven largely by state budget pressures and concerns about long-term revenue stability. So, what exactly is state tax conformity, and why is it changing now? State tax conformity refers to how closely a state follows the Internal Revenue Code when calculating taxable income. Broadly, states fall into three categories: rolling conformity, fixed date conformity, or selective conformity. Recent federal changes have intensified these decisions, including the phase-down of bonus depreciation, the requirement to capitalize and amortize R&D costs under Section 174, and tighter limits on business interest deductions. In response, some states have chosen to decouple fully or partially to protect revenue, while others continue to adopt federal changes automatically. The practical impact can be significant. A business may deduct an expense on its federal return, only to be required to add that same expense back when calculating state taxable income. For example, a company that claims bonus depreciation federally may face higher taxable income and higher estimated payments in states that do not conform to those rules. These differences are becoming especially important as businesses look ahead. The effects of state decoupling are becoming more pronounced in 2025 and extending into 2026. Bonus depreciation continues to decline. Section 174 amortization is fully in effect, and many states have updated or reconsidered conformity rules for upcoming tax years. For many businesses, the federal-state mismatch becomes most visible when modeling estimated tax payments, capital investments, and research spending. Businesses are increasingly reporting higher taxable income at the state level than at the federal level. Outcomes vary widely depending on where a business operates and files returns. This is especially challenging for multi-state businesses, professional services firms, manufacturers, and companies with significant technology or R&D investments. A single federal tax return can now require multiple state-level calculations, increasing compliance costs, audit exposure, and planning complexity. And the financial impact goes beyond compliance. State decoupling can lead businesses to underestimate state-estimated payments, overestimate tax savings from federal deductions, and misjudge the true after-tax cost of major investments. Pass-through business owners often feel the effects directly on personal returns, while corporations may face higher effective state tax rates and deferred tax complications. The bottom line is this: state tax conformity is no longer a background issue. Business owners should review conformity rules in every state where they file, model state taxable income for 2025 and 2026, reevaluate capital and R&D timing, coordinate add-backs and state net operating losses, and closely monitor legislative changes. As federal and state tax rules continue to move in different directions, proactive planning is becoming essential. Businesses that stay ahead of state tax conformity issues now are far better positioned to avoid surprises later. This has been your Interactive Accountant's News Brief. Thanks for watching. For more information, reach out to us online, on social media, or just give us a call. We look forward to hearing from you.